Now, cash management can never be possible without actually having this in mind. Budgeting. Budget. What is budget? A formal statement of the financial resources set aside for carrying out specific activities in a given period of time. So a budget is just a plan of financial resources. How the financial resources will be effectively and efficiently used in the operation of business. So we need to have this in mind. Budgeting is about coordination and planning. Budgeting is about management of resources. And that's why without budgeting, cash management will never be possible. So it helps to coordinate the activities of the organization. So budget will give us direction on how the business activities will be coordinated. Remember, there are three critical activities of business. Number one is operation activities. Number two is investment activity. And number three is financial activity. Now, these are the critical components or activities which are carried out in a business. When these activities are put in place, when these activities are coordinated, when these activities are controlled, the business will be successful. And that's why someone said, if you don't plan, if you fail to plan, you plan to fail. So planning is what entails budgeting. So in our case, if there is no planning, if there is no budget, cash management will never be a possibility. So there are types of budgets that must be put in place. They include the following. We have cash budget, which shows the flow of cash into and out of business. We have working capital budget, which shows the account receivable and the account payable. We have capital budget, which establishes the composition, the capital, the man-made management of items for productivity in the business. Capital like land, machine, how do you manage that? You need capital budgeting. Administrative budgeting, how do you run about the operation of your business? Selling and distribution budget, how will you organize? Because the production of a product is not the end of the business, but the consumption of the product is the end of the business. And the distance between the production and the consumption is selling and distribution. So we need a budget for that. And then research and development budget. We will never be creative. We will never be innovative. We will never improve the value of the business if there is no research and development budget. Research and development budget increases our sales because we'll be able to know the feeling, the taste, the preference of consumers. If you will never understand the taste and the preference of your consumers, your products will never find market. So we need to do a research and development of our market. So these are types of budgets. So our focus will be now on budgetary control. How do you control budget? And in our budgetary control, we'll be looking at only two areas. One, budgetary control in terms of cash management, and then budgetary control in capital budget. Now, a control technique where actual results are compared with the budgets. So when you talk about budgetary control, we are bringing in a mechanism, a tool which will help us in understanding the actual result vis-a-vis the budget itself. Any difference, which is called the variance, are made the responsibility of key individuals who can either exercise control action or revise the original budget. So these are critical elements. Once you have identified the difference, the variance, then initiate the process, bring forth the decision, and the decision can be control action or revise the original budget. The management of money into and out of business over a given period of time is very important. For a budgetary control to be effective and efficient, we must have the responsibility center, which are as follows. So for this budgetary control element to be initiative, to be active, to be resourceful, we must have responsibility centers. Now, responsibility centers are centers which are engaged in controlling the effectiveness of each and every center. So we have 5 centers. Number 1 is the revenue center. So the revenue center is focused on the flow of revenue in a business. Expense center monitors how expenses are incurred in the operation of the business, in the investment of the business, in the financial of the business, and then profit center. So profit center will be engaged in now comparing the revenue and the expenses, merging the two. And remember, revenue only, the profitability of a business can be only established when the revenue exceeds expenses. Without this in mind, we'll have losses in our businesses. And then finally, the investment centers. These are centers which have been mandated to control the investment activities which must be carried in the business for it to be profitability. Remember, when you have one leg, you can't survive in the market. But the more the legs, the better your survival tactics in the market. So businesses will do diversification. They are actually diversifying their portfolio so that they can enrich their business stability. Responsibility centers. Defined as any functional unit headed by manager who is responsible for the activities of that unit. So in each and every unit, there are activities which must be managed. And in each and every activity, you must have this in mind. So there are 4 types of responsibility center as we have seen. So I want us to have a clear direction. Revenue center. What is all about revenue center? Organization unit which output are measured in monetary terms but are not directly compared to input cost. So that is actually the function which is entitled to revenue center. You can't compare the input with the output. Number 2, expense center. Unit where inputs are measured in monetary terms but outputs are not. So you're only measuring the input, not the output. Profit center, where performance is measured by difference between revenue output and expenditure inputs. Interdepartmental sales are often made using transfer prices. So it is here that now you compare the revenue center and the expense center. Investment center, where outputs are compared with the assets employed in producing them. So we need to use what you call ROI, which is return on investment, to determine whether are we making a return out of what we have invested in the business. Significance of preparing a budget control. Importance. 1. Future management. It is easy for us to do future management. You can manage the future of your business. Promote coordination and communication. So with the budget, you can promote coordination and communication in your business. Performance appraisal. It is easy to work out performance appraisal. You can appraise your employees. Enable remedial action. Action can be taken in a very corrective manner. And then improve resource allocation. Remember, resources are scarce. So for it to be productive, effective, and efficient, resource allocation is critical. Economic management. When you talk about economic management, again, looking about production and consumption, we need to strike a balance. At what point? If you overproduce, you will actually make losses. But if you produce within your need, then you make profits. Pressure devices. So budgetary control has been seen as a pressure devices in the unions. Union find that this is very pressure. Laborers are finding that they are pressured to do what is beyond their effort. Departmental conflict arises. So we need to have this in mind. There will be a departmental conflict. Financial department will be fighting with human resource department when it comes to the resource allocation. And this is very critical. So budgetary is not easy. Difficult to reconcile personal and corporate goals. So there are personal goals and corporate goals. Again, this must be reconciled. Waste may arise as managers adopt the view we had better spend it or we lose it. Now that's another problem which is actually faced, the demerit of budgetary. So sometimes the managers can take action so that they can apply what you call it's called, there is a terminology which brings in the application of this we had better spend it or we lose it. It's called, okay, when it comes back I'll give you the meaning. Responsibility versus controlling. So responsibility versus controlling becomes another critical component problem in the operation. Managers may overestimate the cost. So overestimation can arise, and when this arises we might not be able to be realistic in our measurement of targets. So we need to have this in mind. So these are the significance of preparing a budget. Thank you.